Okay, good afternoon, everybody, and welcome to this week's weekly market analysis session. My name is Carl Capolingua. I'm the market analyst over here at Think Markets Australia. It's a pleasure to be with you as we delve into all of the key events from last week and look to the week ahead. Before we get started, it is important we discuss the disclaimer, which says that everything we're going to chat about today is general in nature, general advice only. Please consider it very carefully before you act upon any upon it or seek the help of a financial professional. The rest of the information in that disclaimer is important. You can come back and hit pause in the recording of this session, whether you're watching me live streaming on YouTube or on Twitter, and read it very carefully, or head to our website and download the product disclosure statement or PDS for more information. All right, let's get going with the crypto to kick off with first. Sorry, there we go. And we can see that the Fear and Greed Index down to 21. That's below last week's 24 last time we caught up, and pretty much falls across the board. I do take a snapshot Saturday to Saturday. You've got to end the crypto week somewhere because it does trade 24/7. And today's, I should say Sunday's candle and today's candle showing some further falls. So probably knock off another 2 to 3% of many of those numbers. Solana, 20% fall, still suffering from that FTX fallout because FTX was a major holder and backer of that cryptocurrency. Other than that, majors like Bitcoin down somewhere around about 3%, and Ethereum suffering there around about 6%, but no light on the horizon, unfortunately, for the crypto universe. Bitcoin chart demonstrates that it's still all about FTX, it's still about contagion, it's still about who's going to go next. And we can see that we are just trundling along the bottom there at 15,563. I fear that if we break that, we are at the very least going to test 13,870. That's the top of the 2019 bull market, not far away from here, and then 12,479. There's nothing in the candles or the price action to suggest otherwise, as in it's a very bleak picture. I can't see the fingerprints on demand, or certainly not enough to suggest we can go up and get through that light pink band there, which I do feel now is resistance or a supply zone between 17,585 and probably up to 18,608. Hey, if by some miracle we do get there, then I do think there will be some short covering at the very least, maybe even a little bit of FOMO coming back in. But really, it won't be until we're above 21,474 we could even contemplate that long-term downtrend is being challenged, and really not until we get above 25,366 could we say that it is changing. Until then, the path of least resistance, as is very clearly demonstrated by my short-term and longer-term trend ribbons, is to the downside. Not much better on Ethereum. You can see that Sunday candle there actually reaching a little further down to its key level at 1071. I mean, if there is a highlight there for Ethereum, it didn't take out its key low like Bitcoin did there at 17,585, I think it was. So it did hold above 880, for example. But I think that's where we're headed, unfortunately. Somewhere between, say, the 1,000 handle and 880 could be the next point where we do see some bargain hunting coming in. Hopefully some demand side candles, they would be the white candles, the candles with lower shadows, to tell us we might get a bounce. Until then, again, the path of least resistance is very much skewed to the downside. Okay, let's have a look at how stocks went during the week. A little bit of a mixed bag. US equities generally lower, but certainly the risk on end of the spectrum underperforming. NASDAQ down nearly 1.6%. And then you've got the value end of the spectrum, which is the Dow Jones. They are the 30 biggest blue chip stocks in America. And many of those are well-established, dividend-paying, we call them obviously value stocks or defensive stocks, which are less exposed to the economic cycle. And with many investors positioning for a potential recession in the US and many other economic jurisdictions around the world, you can see why those stocks are being favored if you are forced to buy. And many big fund managers, don't forget, are mandated to buy. They absolutely must buy. The money keeps rolling in from pension funds, people's pension capital, people saving for their retirements. Over here we call them superannuation funds. That money, X% of it, 40, 50%, whatever it might be, has to be invested in stocks. And therefore you get this ubiquitous forced demand coming to the system. And if we have an absence of negative factors, we're seeing some of those inflation numbers starting to cool the expectations that we've already reached peak rates in that supply vacuum. It does facilitate, stocks, buying of stocks, but what are you going to buy? You're going to buy the biggest defensive stocks, or you're going to go for that risk on end of the spectrum. If you look at the NASDAQ, they're more growth-orientated stocks. They're stocks that have high PEs if they are earning money, or if they're not earning money, pre-earnings, they have high debt levels. So when interest rates go through the roof, it's those NASDAQ stocks that tend to suffer the most. So if you're mandated to invest, think about where you're going to invest, okay? And that's exactly what we're seeing bearing out in the Dow Jones, and it's also happening here in Australia. Look, apart from that, we've got a bounce in Chinese shares, which was mainly based around a property support package announced by Beijing, a number of measures to extend sort of credit facilities, debt repayments by a number of those ailing. Some people call them ailing. I call them zombie property companies that have huge backlogs of unfinished properties, and properties that if they are finished, they cannot sell those apartments. Demand has crashed, prices have crashed, and there is going to be a real problem there. There's about $300 odd billion worth of debt repayments due over the next 12 months. Many of those already are in default. Okay, so we got a package that was about 50 or 60 billion off the top of my head, and it is a band-aid on a broken leg. I've got some charts for you on that in a little while. We'll see market response through indices and commodities, and maybe a little bit of where to. Hello, Roman. Hello for tuning in. I'm not going to do any requests today. This is more just an overview of where markets are at. That's tomorrow. Ask the experts. That's where you tune in and ask me to look at your portfolio. European stocks were high. You can see the volatility index lower, in keeping with this lack of bad news, supply vacuum, or supply catalyst vacuum more specifically. Let's have a look at some charts on the American markets, S&P 500 first. And this is kind of caught between that Dow Jones and that NASDAQ. It's certainly a broader measure than your big blue chips, but it is still blue chip dominated. And you can see that it has actually had a really nice rally. That short-term trend is now up. That's the light green zone over here. The long-term trend is still down. Make no mistake, it's still down, but it is starting to moderate. That's my traffic light system. So obviously when this is pink, I don't make it red because it makes the black numbers hard to see. So I go green for up, orange for a transition or caution, and then pink is for down. We have moved more to that caution or neutral stance here because the short-term trend has pushed into that zone. And the moving averages I use here have stopped expanding, so momentum to the downside is diminishing. Our price action is pretty solid with higher peaks and higher troughs, and candles are showing more white candles than black candles, and if there are white candles, the bodies of those tend to be a bit bigger than the black candles in the upper shadow. So all pretty solid here to continue to move higher. I'm yet to see enough supply in this zone to suggest that it will be reinforced, and again in that supply vacuum, I think that the path of least resistance in the short term is up, so position therefore for further gains. We are seasonally at a time where markets tend to do well through this late half of November into sort of, as could be really even February, late February, that you don't tend to see those seasonal peaks again. So stick with that, I would say, and I'm not calling the US bull market just yet, but I think we're getting close to the point where, based upon the S&P 500, you would say that the bear market is over. Can't say that on the NASDAQ because you can see, again, that risk-on end of the spectrum hasn't done as well. And it really won't be until we see this do better, until we see this test test, hold, get through, traffic light system, change this to orange, that we're in a US equity bull market. So we're not there yet, but again, with reasonable candles, reasonable price action, probably we can move into, say, that 12,000 zone and test this level as well. And this is kind of where it's at. Look at the Dow Jones Industrial Average, how well that's done, how much better than the S&P 500 it's done, how much better than the NASDAQ it's done as well. And put myself back in there. And this is raring for a breakthrough, potentially that sort of 34.4 and maybe even going testing 35.5. So seasonally, it's the time of the year where these things can happen, and I would suggest not fighting it. What does that mean for your portfolio? Well, I've been advocating for very high cash levels for many months now. I think that has been valid as the price action has shown, but strategically putting some money to work, I certainly would maintain higher than usual cash balances. Certainly not bull market cash balances. A bull market cash balance is about 10%. So I think you want to be higher than that, but very small, strategic and diversified holdings. So don't necessarily concentrate your holdings into 1 or 2 or 3 or 4 stocks, but I think have much smaller holdings across many more stocks, so that if 1 or 2 of those stocks do blow up on you, because the risks are still high out there, it's not having an outsized impact on your portfolio. I mentioned the broken leg on the Band-Aid earlier on for the Chinese property market. This is, this is the world's biggest asset class, over $1 trillion. So it is important, and it's a huge driver of Chinese growth, which is then a huge driver of global economic growth. And so important, of course, for what we do here in Australia, because we are such an export-oriented market and oriented towards the Chinese economy. So this is the Hang Seng Mainland Properties Index. You can see there, I've marked in the middle, the all-time high was at 8205, got as low as 1400. Now, I'm not great on the maths, but I'm going to say order of magnitude, 80% decline from the high. So that's kind of giving you a bit of a clue there. When something goes down 80%, it's because it's not in good shape. We have had a rally though. That's the whole point. This Band-Aid on the broken leg has taken us from 1400 to nearly 2400. So even in percentage terms, that is a massive rally. And you can see we're just sort of peeling back again. It hasn't changed. Well, the short-term trend, I would say, is neutral, but hasn't changed it to up yet. And the long-term trend is still very well established to the downside. So I'm just saying, keep an eye on that space. And a great little segue, isn't it, now into our commodities discussion, because so much of this will depend on what happens there in that Chinese property market. And you can see the iron ore chart is almost exactly the same. So if I do flick back there, you can see, lo and behold, there's your iron ore chart. So if you own BHP or Rio or Fortescue, and you're wondering, hey, will my stock be up or down over the next few months? This is the chart you need to watch. There you go. Answered your question. Aluminium down, copper down sharply during the week. Again, first half of the week was all about that rescue package, support package they call it. Second half of the week, I think, is about economic realities, where the IMF just locally come out and say that we should expect lower growth over here in Australia. Nickel down 5% after its big gain last week. It was up about 15% last week. Tin still managed to gain. There's copper in the US that was down sharply. Iron ore, as we can see on screen, still managed to gain, and they fall away from their precious metals, were down on a bit of a rally in the US dollar. Having a look now at the coking coal price. So this is the key contributor, with iron ore to make your steel, which again is being used. So I know I'm throwing lots of stats at you at the moment, but so I think 2/3 of the demand for steel goes into that Chinese property market, and we're seeing here these prices come back quite sharply, even though there are some supply side constraints there with the wet weather on the east coast in Australia. Having a look at high-grade copper, again, Dr. Copper, this, it's ubiquitous, its use in industrial applications, and therefore, if it's going up, it's a great indicator that the global economy is strong. If it's not, then, global economy is not strong. And that's kind of what we saw this week. So it peeled off really sharply after we saw that short covering rally on the back of those easing, so it was a 20-point plan on easing the COVID restrictions in China. They're saying they're going to move to a more targeted approach. It's certainly closer to their zero COVID than it is to freeing things up. And we have seen an exponential rise in cases up to about 27,000, I think I'm going to say off the top of my head. Don't quote me, someone will scream at their screen, but give or take, it's around that many now. Copper obviously pulling back there. Nickel coming back down. The reason for the rally, I talked about it last week, there was some rumors of an outage at one of the Indonesian miners that was since dispelled because stocks are very low for copper. We saw that stocks are low for nickel, both in London, both in Shanghai. You are seeing any good news turning into a really, really sharp rally. But what we can see here, we haven't seen in stocks, is that the supply is around. So the supply is there after those price spikes to push them back down again, because many investors are positioning for weaker global growth down the track. Not happening in stocks because of that mandated, that forced buying. That's my theory. Gold pulling back on a rally in the US dollar, but otherwise it's a very shallow pullback after a very sharp rally. So if you are a gold bug, I don't think you need to worry too much about that. I want to see some white candles come in around about 1730 to 1735. White candles, long lower shadows, would confirm this new short-term uptrend, which could then really change that long-term uptrend. But until I see that, I'm going to stay neutral on gold. Crude oil coming off during the week. You can see down as much as 10% there on the WTI, and then about 8.5% on Brent. Natural gas rallying, but we'll see when we get to the chart. 8% sounds huge, but it didn't look like much on the chart. The Aussie dollar was down as the US dollar rallied, as I said, across the board, and that caused also some weakness in some of those commodity prices. Bonds were pretty flat. Let's have a look at the natural gas price. You can see, well, you have to squint a little bit to see that up trend at the end there, the 8%, but it is there. Trust me, I double checked and measured it. But overall, I'd say this one's very neutral. You can see the short-term trend is neutral, long-term trend is neutral, and we're just hovering beneath that long-term trend zone. So we know on the way up, this trend zone tends to act as support. Once you get into it, break beneath it, it then starts to act as resistance, and that's what it's doing right now. So I think neutral is the best course of action. If we can close above 723, I think you can move back to longs. If it's back below 554, you're probably moving to shorts. Having a look at the European natural gas prices and the big trade that was supposed to happen was the shortage of natural gas in Europe. Blizzards, whiteouts, and people scrambling to keep their homes warm. Didn't happen. Inventories are high, and we've had some unseasonably warmer weather, so we've seen those prices come back, but potentially looking like they're stabilizing there at 105. Newcastle coal futures important for our coal stocks over here, like Whitehaven, New Hope, and Terracom, Yancoal. It did bounce actually during the week, so we've seen a little bit of a stabilization in some of those share prices. This is why. From 287 hit close to 340 there. And I would say, despite that though, the problem is that this area does become resistance now. I think, the tide has turned, and I think the market will shift more to supplying into the rallies rather than buying the dip. And that's kind of the thesis behind this change of trend. Markets go from buying the dip to selling the rallies. So watch out there. Very neutral, I think, on uranium. We are stuck in a range. Love to see it close above 53. Might bring in some FOMO. Don't want to see it close below, say, 47.90. That would really change things around. US dollar had a little bit of a rally during the week, but it was extremely volatile. It has had a major pullback here, and it's a trend-ending pullback, to be fair. And we're going to see how it performs in this zone because, like many of those charts, we didn't see a sharp bounce back, and what we saw is actually time in the zone and then a break below the zone. Given the severity of this correction, given the candles and the price action, there are some really big supply side candles in there. I'm actually going to say look, even if it does rally, it's probably going to be limited to here. But I do think we are in a transition phase here for that long-term trend that could support commodities down the track. And I guess it does facilitate, risk taking as well, or I guess it unwinds the risk-off bent that US dollar represented for so many months, and with that, freeing up of risk, it can facilitate some risk taking. Having a look at the Australian dollar versus US dollar, key risk-on proxy, isn't it? It's like the ultimate global risk-on proxy, a little bit like the gold chart. Short-term uptrend, long-term downtrend. Long-term downtrend, you can see, is so powerful here, so powerful in dictating where these reversals, these rallies in the bear market are going to terminate. And we've hit it with some black candles and some upper shadows. So I'm going to say, maybe unlike gold, which looked a bit stronger on a relative basis, this one is weaker, and I could see it coming back into, sort of 65.20 possibly. We'll see how it goes from there. I wouldn't be averse to adding some short side exposure here. Okay, but just dipping a toe in the water on the basis that maybe that is the top, with pretty tight stops and not a whole lot to lose, not too great a sting in the tail if it does take out that high there at 67.97, and then if it does start to come down and then building into a larger short position based upon that long-term downtrend. Australian 10-year bonds flattening out. The question here is, and this is why I show you the bond charts, is have we hit peak rates? I think there's an increasingly, the chances of that are increasing based upon the technicals here. Have we reached peak rates in the US? It's starting to look more like it. I don't think it's as convincing as the Australian one, because if you look at the Australian one, look how sideways that's gone over a prolonged period of time. It's had the opportunity to go up and it hasn't. And of course, we're talking about bonds going down because there's an inverse relationship between your bond prices and your yields. So these yields coming, yields coming down as bonds going up. Okay, so can we see a bond market rally? And that's looking increasingly likely. US 2s, this would be the strongest one and the one with the greatest potential to go up. And I would suggest if this went back up to 5%, it would bring some supply into equities. So charts all worth keeping an eye on. This is a chart that's definitely worth keeping an eye on. It's US yield curve, and we have seen the sharpest inversion and I think the longest as well, the longest inversion now since the last major recessions. So certainly since the GFC, and then there was one in the 90s, and then there was one in the 80s, and one in the 70s, and the oil crisis, and these major recessionary periods. This is what we're seeing right now. It tends to be a precursor. It tends to happen in advance, so it's a great predictor. It's extremely accurate, and it steepens. Certainly rates came down. We can see that rates have come down, and that has helped stocks rally, but the steepening of the curve is what I'm concerned about here. Okay, let's have a look at data out of China. Fairly benign. Look, fixed asset investment actually better than expected, 5.8 versus 5.5, but pretty flat there. Industrial production at 5%, a little bit worse than expected, swings and roundabouts. Retail sales, though, that was quite a big miss to the downside, those lockdowns having an impact there. And then the unemployment rate was slightly worse than expected, but only slightly so. I don't think we're taking huge cues from the China data. In the US, we did see wholesale inflation coming in better than expected. That helps stocks as well. Obviously backing up that recent CPI print. Retail sales a little bit better than expected. I'm not sure if the Fed will like that. They want consumers to slow down, and it's pretty clear from that data consumers are not getting the message. They are still spending. Having a look at this one here, which is the home builders index, and then permits and starts. So we're looking at the US property sector, and this is really important because it is such a big contributor to US GDP. And look at that NAHB survey on the left. That has absolutely gone into the toilet. We're at COVID levels. Think about how negative things were during COVID for home builders. Just lockdowns and no workers, and people are sick, and there's pandemic and mass graves being dug. Just think about how horrific things were. And here we are, nearly 2 years later, and home builders are as bearish as they were then. That's painting a pretty bleak picture for the US housing market, and permits and starts. They've topped. They're heading in the other direction, actually looking pretty similar to those 10-year yields. So what that yield curve inversion, we saw the strength of those 2-year notes, and then relatively speaking, the weakness in those 10 years, and that's creating that inverted yield curve. So this is saying that somewhere down the track, there's going to be so much damage done to the US economy, the Fed will have to cut rates. And that's why those longer term rates are lower than the near term rates, which is the opposite of what you'd expect because of the time value of money. Having a look at the Aussie data, 32,000 jobs created. That was way ahead of market expectations for 15,000 jobs. You can see there a pretty nice jump in full-time workers as well. So that's a very strong reading of the Australian economy, employment market. Employment rate surprisingly falling to 3.4%. The expectation was 3.5%, and participation rate was steady. So again, local economy here is very, very strong. And I think that now creates a lock. It's a lock for a 25 basis point hike at the next meeting for the RBA in December. And I wonder if the rhetoric will move back to maybe a 50 basis point hike. I don't know. 25 is a lock at the very least. Aussie shares for the week were a bit of a mixed bag. You can see there, obviously, with the oil prices down, energy was down, gold was down, so the gold sector was down. But material sector up because it is dominated. So yeah, copper was down, nickel was down, but that materials index is dominated by BHP, Rio, Fortescue, and they are iron ore miners, and the iron ore price was up. Financials took a little bit of a breather there. Otherwise, it was fairly quiet, wasn't it? Property trusts down. I'm not sure. It's not like interest rates were rocketing higher, but they are an interest rate sensitive. On the technicals, we can see. Let me just move that for you so you can see see what's happening under there. And as I was saying on the technicals there for the ASX 200, the most impressive thing is this candle. This was Friday's candle. That was in response to that better than expected CPI data in the US. What's important last week is just these tiny, tiny little candles, Monday, Tuesday, Wednesday, Thursday, Friday, such a tiny pullback. Really nothing sinister in the shape or the nature of them, the color of them, the bodies. And what that's telling you is there's a pile of demand just sitting here trying to soak up stocks, anything that comes out. But the thing is, very little is coming out. So you've got this huge amount of demand. There is a supply vacuum at this point in time. There's no real major catalysts for active fund managers to supply. So in the absence of that supply, and think about it, normally when things go up a lot, and they have gone up a huge amount from the lows, you expect to find sellers out there. There are no sellers. It's just demand, and therefore the path of the least resistance is higher. We're going to check out 72.89 probably, unless we see some really black candles today, or that supply event occurs. I don't think it will, based upon what's coming up this week. There's just not enough coming up this week to cause that. So we probably will just trudge higher. I don't think we're going to burst higher, but I think we'll trudge higher because, whilst demand is in the system, clearly it doesn't want, it's patient. At this stage, it seems to be patient. There's no FOMO just yet, fear of missing out. The concentration worries me, I think, on the Australian market. And I forgot to put this chart in, but I ran it on Friday in my Auspice spot. The ASX 20 leaders versus the small ordinaries, and it's almost exactly the Dow Jones versus the NASDAQ. So that our ASX top 20 is effectively the same as the Dow chart. It is, changing into, almost a bull market already. And yet those small ords, those small companies, there's, 500-600 companies there, much smaller companies that represents the NASDAQ, for example, looking far, far worse. Definitely not an uptrend, still a well-established downtrend. So anyway, I'm trying to paint the picture with 1,000 words here. But it means concentration. So it means crowding. It means fund managers who really are buying, buying almost reluctantly buying. They're buying the biggest, most defensive names because it, in theory, makes them feel safe. So sounding out that warning. Having said that, again, these indices are dominated by these larger, safer companies, and that's causing some of those trends to turn around. I think you can get by the tone of my voice. I'm kind of not believing it. I'm happy to look at very specific opportunities, nice charts that are turning around, but I'm not going all out at this stage. Having a look where the value might be in the Australian market. Well, the current ASX 1-year forward P, this comes from Thomson Reuters, and they aggregate the biggest brokers out there, 15 to 20 of them, and they are reckoning that the 1-year forward PE for the ASX is 13.6. Fair value historically is about 15, and expensive is 20. That's where all the major market tops. So think about GFC top, 87 top, 29 top. They all came in the 20s, whether it be here or in the US, and the huge bear market lows, the crash lows all came sort of 10 or sub 10. So we're on the right side of fair value. I think that's the message there, but it is, dominated again by the low PE sectors, your financials, 13.4, and then your energy and your materials, which are still below average because they're cycling huge bumps in earnings on those recently post-COVID high commodity prices. Those commodity prices are coming down. Apart from that, let's look for things that might be close to fair value. Discretionary, not that far away, 19.6 versus the long-term pre-COVID average there at 18.9. Healthcare still looks expensive. The CSL and Cochlear index at 30.7 is expensive, I think, compared to 27.9. Technology is starting to get back to that long-term average. In fact, I'm going to suggest this is the lowest we've seen it post-COVID. This is the lowest we've seen it post-COVID. It is a fraction of that 77.4. You can't say there's bargains in there, but at least it's getting close to fair value. We've talked about materials. Property trusts are looking cheap. There you go. Property trusts are looking cheap here. Staples, still probably on the, you'd put that in the expensive category. Telecom is looking crazy expensive. How about that? And utilities are starting to look a little cheap as well. Okay, upcoming events for this week. We've got RBA Governor Lowe speaking tomorrow evening, and then some PMI data, manufacturing services, coming out after that. Looking abroad, we do have those equivalent PMIs coming out for various regions around the world, but US specific core durable goods orders, that's definitely watched quite closely by the markets. And the FOMC meeting minutes, they will be very closely watched by the market. So we're going to get our dot plot, of course, and some narratives around the Fed's most recent 75 basis point increase in interest rates. If you would like to join me and Raman, who was asking about some stocks earlier on, for my Ask the Expert session tomorrow at 1 p.m. Sydney time, where I will take all requests, look at your portfolio, give you a good technical and fundamental reader where possible. Head to www.thinkmarkets.com/au/webinars to register, or hang around on the YouTube around that time. I'll be streaming it, or on the Twitter as well. If you don't know who Think Markets are, we are the good guys in the Australian stock broking scene. We have over 3,100 shares and ETFs you can trade for your self-managed super fund. $8 flat rate, CHESS sponsored. It's important you're CHESS sponsored. There are cheaper rates out there, but they're not CHESS sponsored. If you don't know what that is, I'm not going to waste time telling you about it today. Google it. But it's important you have that. And then the other great thing about us is you have your self-managed super fund going over here, and then over here you've got your CFD account where you can do your trading on your foreign exchange, your indices, commodities, futures, crypto, and shares if you like, at very, very tight spreads, or commission-free for those ASX shares and US shares as well. We are an award-winning broker, been around for many, many years. We are regulated all over the world. We have offices all over the world. In Australia, we're based in Melbourne, and we're regulated by the Australian Securities and Investment Commission. World-class trading apps on your phone and on your PC, dedicated account manager with 24/7 customer support, somebody you can actually talk to, none of those silly chatbots, somebody who'll get to know you and look after you through your investing journey. Head to www.thinkmarkets.com/au for details. If you're watching me on the live stream on YouTube, please hit the subscribe button to stay notified of any of my future updates, and you will get notified every time I do go live with a stream, which I do regularly during the week. And hit the like button to let me know you like what I'm doing, so I continue to do more of it. Ditto goes for those watching me on Twitter. Well, it's been a real pleasure chatting with you today. Hopefully I've brought you up to date on everything that's happened last week, and we'll catch up very soon. Bye-bye.